Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Wednesday, May 13th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were down 1.75% on the S&P 500 and closed at 2820. What we're looking at here is a one-day chart of the S&P 500 where each candlestick represents 1 minute of trading. And the dotted blue line, of course, is where we closed yesterday. So we can see here that we gapped down at the open and then started to rally a little bit. And we had just a few minutes where we traded positive for the day just after 10:30 in the morning. And then just after that, we started to quickly sell off. And what's really interesting here is that once we sold off, we came down, and I drew this blue line at 2,800, and it's really interesting. You can really see the algorithms kicking in here at exactly 2,800. We bounced off of this just after 12:15 in the afternoon and then made our way back down there, and exactly at 3 o'clock, you can see we touched that 2,800 level again, bounced off of it, and then undercut the 2,800 level for just a few minutes and got down to our lows of the day, which was 2793.15. And you can see that from that point, we then ricocheted off of that 2793.15 level. And look at the volume, how it came in on the buy side. Once we got below this 2,800, there must have been an algorithm that was triggered to start to buy once we got down here under this 2795, 2794 area, and that'll make more sense when we take a look at the next chart I have prepared for you. But you can see the buying that came in right after that, and the black bars, of course, are up volume, and the red is down volume. So you can see a bunch of buying came in right after we hit that level. And then it pushed us up a little bit. We still had a very bad day today, but it's really interesting that there must have been an algorithm with a buy signal triggered right around that 2794 area, because once we hit that 2793.15, just below 2794, then we got that purchasing coming in and pushed the market a little bit higher, and again finished exactly at 2820. Now what we're looking at is a 15-day chart of the S&P 500 where each candlestick represents 15 minutes of trading. You may remember this chart from last night, but I wanted to bring it back for a couple of reasons. We know that this uptrend line was broken yesterday, and you can see here today's trading action. But again, I've got this 2,800 level line drawn right here, and if you go back to May 4th, look at how we bounced off of that 2,800 level right there. And then I also drew this 2794 line even before. I mean, we were trading at around 2810 when I started to prepare these charts. And I drew this 2794 line because back on April 24th, you can see that we got down to this 2794 area, and we had some buying kick in there, and then we had this rally for the next few days. So we had a very, very similar thing happen. Of course, we had a little bit more trading on the 24th, down between 2794 and 2800. However, we at least triggered it, right, for just a couple of minutes today. And again, you see that buying coming in. So again, there must be an algorithm out there that is programmed to purchase once the market dips below 2,800. Now, the question becomes, was this sufficient to give us another one of these types of rallies that we've had the last couple of times we've come down to this area? It's happened several times where we get down below this 2,800, down around 2794, and then we get a rally for a few days. So it's happened a couple of times. Could it happen again? Of course it could. It's really hard to tell with all the Fed liquidity that's come in. The market is obviously trading on news-driven headlines and stimulus. It's not trading on fundamentals, so it's very, very difficult to tell what's next, whether we're going to be up over the next few days like this, or if we're going to continue to roll over. Every sector of the S&P 500 was negative today, as you can see here. And let's just take a look. Utilities did best. The utility sector was only down 0.87%, and the energy sector was the worst performing sector of the day, down 4.46%, and then financials was right behind that, down 3.05% for the day. Again, the S&P 500 finished down 1.75%. And you can see the technology sector, which really has been the strongest sector since March 23rd, that was down 1.76%. So we're really starting to see some weakness in the technology area. You know, technology, healthcare, those were the areas that really led us off the bottom, and we're starting to see all of this roll over. So a big question mark as to what the next couple of days may look like. And now we're looking at the capitalization. So what we see here is whether it was the Dow, the S&P 100, S&P 500, the Wilshire, everything was down today. Okay, as we can see, every capitalization was down today, and even the triple Qs, which the NASDAQ 100, which has been one of the strongest things out there since March 23rd, was down 1.21%. So again, we're starting to see a lot of these things that led us higher break down. And for the day, the triple Qs did best, only down 1.21%, where we had small caps like the small cap 600, the S&P 600 small cap ETF, IJR, down 3.76%. The Russell 2000, which is a broader measure of small caps, measures 2,000 small caps, where the IJR is 600. It was down 3.40%, the Russell 2000 was, and then mid-caps were down 3.38%. So, again, weakness across every sector, weakness across every capitalization. We are definitely going down here. The question I posed last night was, will we get lucky and the market only correct down to about 2,800? So far, that's exactly what we've done. Now the big question is, will 2,800 hold, or are we going to roll over and go even lower from here? The weakness that I'm seeing in everything that we see here tells me probably lower, but there's no way for any of us to know for sure. What we're looking at here is a year-to-date chart of the S&P 500, where each candlestick represents 1 day of trading. And of course, you can see over here on the right-hand side where my cursor is moving, that is today's trading action. And the Fibonacci lines, of course, I have this overlaid, and we can see here that we bounced off just almost exactly off of this 50% retracement level. Of course, this is from February 19th to March 23rd, which so far has been the lows of this correction, which was a bear market. And you can see here that this 57 number is set around this 27.93, and we got right down to that today, bounced off of this 50% retracement level, and finished just above it. And you can see here over the last couple of weeks, it's almost like a video game. We've been pinging and ponging between the 2,800 and about 2,935 levels, which is representative of the 50% and 61.8% retracements of this entire downturn. And you can see here that we've been just bouncing back and forth between the 50% and 61.8% retracement lines. So very, very interesting. The question again is, will this 50% retracement level, let's just call it 2,800, it's slightly below that, but let's just call it 2,800 for easy math. Will this level hold? We saw on the shorter term charts, the intraday chart, where we had an algorithm kick in and start to buy once we dipped just below this 2,800. Is that going to be sufficient enough to give us a boost back towards the upper trend line, which again right now is around 2,935, that 61.8% retracement line? Only the next few days will tell. Nobody knows. But one of the things we can tell from looking at this chart is that if we break below 2,800, there's not a lot of support down to what would be the 38.2% retracement line, which is right at 2,650. So my guess is if we break below 2,800 over the next few days, we'll go down to at least 2,650, if not 2,630, which we know there's some support right here at this 2,630 level. Now what we're looking at is a very similar chart. This is a year-to-date chart, except now we're looking at the IWM, which is the ETF that tracks the Russell 2000, the Russell 2000 small caps. Now we know that this ETF was down 3.4% today. It's kind of hard to see this because I've got the Fibonacci lines overlaid on top of this, and it's really hard to see this. But we were down about 3.4% today, May 13th, on this ETF, on this index, the Russell 2000 small caps. So a couple of things to take away from this. First off, the Russell 2000 peaked in 2020 back on January 17th, a full month before the S&P 500 peaked back on February 19th. So that's one thing to take away from this. Now, I like to use small caps like the Russell 2000 to verify moves in the larger indices, the S&P 500. And what we can see here using the Fibonacci retracements is that with today's action, we are now back below the 38.2% retracement of this move, okay? Which this move on the Russell 2000 started back a month earlier than the S&P, again, back on January 17th. So that's why I have the Fibonacci retracement line set back to the highs that we saw on January 17th, which wasn't much higher than what we saw on February 19th, but it's slightly higher. One of the reasons I like to use small caps is they tend to be a little bit more sensitive than large caps, and they oftentimes will peak a few days or a few weeks before the large caps. In this example, January 17th, the small caps peaked. But again, when we go through this downturn and look at this, we can see here that the small caps have only retraced now a little less than 38.2% of this move. So the reason this is so important, the reason I'm telling you this today, and by the way, look at the volume, okay? Look at this downside volume that's accelerating to the upside as we go down. That again is another bearish sign. So we've got negative volume. We've got this volume increasing to the downside. That is not a positive thing. In order to have a long-term, strong, sustainable uptrend, you need small cap participation, and that's why I wanted to show you this chart. The small caps, as we see here, are just not confirming the large cap movements. The small caps are still very weak, and at this point have only retraced about 33% of this move to the downside. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. I hope you've enjoyed today's session. Please remember to subscribe to this channel, give me a thumbs up on this video, and check out some of my other educational videos. I have a lot of great market-related videos on this channel. Also, if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, your 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here's some additional information. As part of the Simple Market Signals model, there are two powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. And if you want even more information on Simple Market Signals and some of the strategies that you can use on the various signals, this is a very in-depth video that I will have linked in the description box below this video, along with a bunch of other videos that you may want to explore if you need additional information on Simple Market Signals before you subscribe. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple.